Crypto regulation in the US has been a mess for years. Projects sued without warning, tokens labeled securities overnight, and exchanges stuck guessing which rules apply. But now, a massive new bill, the Crypto Clarity Act, is trying to change everything. The question is, will this finally bring stability to crypto regulations, or will it quietly kill some of the biggest opportunities in the space? What's up, guys? It's Jordan Crypt here from Coin Bureau. If you're new to the channel, subscribe and stay tuned until the end of the video to get all of the important information. Let's break it down. The problem. Up until now, US crypto regulation has basically worked like this. Regulators don't give clear rules. Companies build anyway, then they get sued later. This is what's called regulation by enforcement. And the core issues are, no one knows if a token is a security or a commodity. No one knows whether the SEC or the CFTC is in charge, and investors are left in the dark. This uncertainty has pushed innovation out of the US and kept big institutions on the sidelines. The Clarity Act aims to fix that. So, what is the Crypto Clarity Act? The Digital Asset Market Clarity Act is the most comprehensive attempt yet to create a proper rulebook for crypto in the United States. It already passed the House in 2025 with strong bipartisan support, but it's still working its way through the Senate. At its core, the bill does one thing. It turns unclear guidelines into actual law. Instead of guessing what regulators might do, you finally get a defined framework for how crypto markets operate. So, the 6 major things the Clarity Act does that actually matter. First, it classifies digital assets into 3 categories. Second, it gives the CFTC exclusive regulatory jurisdiction over spot and cash markets for digital commodities. Third, it creates a provisional registration regime. Fourth, it protects decentralized finance. Fifth, it creates a new capital raising pathway for digital asset projects. And sixth, it prohibits the Federal Reserve from issuing a central bank digital currency to individuals directly or indirectly. So, the key provisions. Here's where it gets interesting. Number 1, who regulates what? The Act largely gives oversight of most crypto assets to the CFTC, not the SEC. The Commodity Futures Trading Commission is an independent U.S. federal agency that regulates derivatives markets, including futures, options, and swaps. So, most tokens would be treated more like commodities. Think Bitcoin, not securities like stocks. The Clarity Act significantly narrows the scope of assets that the SEC can claim. By defining most blockchain-native tokens as digital commodities rather than securities, the bill moves regulatory authority over the largest and most active part of the crypto market to the CFTC. The SEC retains jurisdiction over primary market fundraising when a project first sells tokens to raise capital, and over any digital asset that functions as an investment contract. For secondary market trading of digital commodities, the CFTC takes over. Number 2, clear token classification. The bill helps define categories of crypto assets, reducing confusion around what qualifies as a security. This is huge because right now that decision often happens after projects launch. Number 3, rules for exchanges. Crypto exchanges would finally get a clear framework, how they register, what disclosures they need, and how trading platforms must operate. Number 4, stablecoin restrictions. This is very controversial, and this is the big one right now. There are proposals to ban or restrict yield on stablecoins, basically stopping platforms from paying interest like rewards. That could kill things like earn programs, passive yield on USDC or USDT, and some DeFi-style incentives. And this is exactly why the bill is facing pushback. So let's dig a little bit deeper into this controversy. This is the most contentious part of the Act, and it actually has nothing to do with jurisdictional structure. This amendment is backed by the US banking industry to prevent crypto exchanges from paying interest to customers who hold stablecoins. In my opinion, this is clearly seen as a risk from banks to their market share. The banking industry's argument is that a stablecoin account that pays yield is equivalent to a savings account. banks offering savings accounts are subject to deposit insurance requirements, capital requirements, and the full weight of federal banking regulation. Crypto platform that offers yield on stablecoins without those requirements is, from the banking industry's perspective, competing on an unlevel playing field. The crypto industry's counter-argument is that stablecoin yield is actually revenue sharing from the interest earned on treasury bills held in reserve, not a deposit product, and that restricting it damages legitimate business models without a corresponding consumer protection benefit. For Coinbase, stablecoin-related revenue represented close to 20% of total revenue in the third quarter of 2025. Armstrong described the yield restriction as a provision designed to protect bank profits rather than consumers. This also tends to be my own personal opinion, as the market share of fiat banks are being threatened by stablecoins and their ability to generate higher yields than traditional fiat savings accounts. So, who actually supports the Clarity Act? The White House has been the most vocal institutional supporter. Trump signed an executive order in January 2025 redirecting federal agencies to take a more favorable posture toward crypto and directed his administration to make the United States the crypto capital of the world. We see lots of major players in the crypto industry very positive about this act being passed, including the Ripple CEO, JP Morgan analysts, and it seems like the stablecoin yield part of the act is what actually needs to be amended in order for everyone to be happy about this passing. Coinbase actually withdrew their support in January, but followed up saying that they were in conversations and working toward a compromise. The Blockchain Association sent 21 executives from 18 companies to meet with 24 Senate offices, specifically on the DeFi provisions. So, who opposes it? The American Bankers Association has lobbied against the stablecoin yield provisions, and the ABA's position is that yield-bearing stablecoins on unregulated platforms create a regulatory arbitrage that disadvantages traditional banks. So there really is a big battle going on here, and it doesn't seem like there's going to be any real possible agreement, and it will have to come in the form of a compromise if this bill is going to be passed. The North American Securities Administrators Association, which represents state security regulators across all 50 states, expressed concern that the bill weakens state enforcement authority over digital asset fraud. Some Democrats have argued the bill does not adequately protect retail investors and moves too much authority away from the more experienced SEC toward the less resourced CFTC. And very interestingly, Cardano founder Charles Hoskinson called the bill in its current Senate form a horrific trash bill that could push future crypto founders offshore. His objection was to specific DeFi provisions he argued would harm decentralized protocol developers. The detail here is that there are currently two Senate versions of the Clarity Act moving on parallel tracks. The Senate Banking Committee is marking up provisions covering SEC-related elements, investor protection, securities treatment of digital assets, and stablecoin regulation. The Senate Agriculture Committee is marking up provisions covering CFTC-related elements, commodity market oversight, exchange registration, and derivatives. Both committees must complete their markup processes before the bill can go to the Senate floor. The two versions must then be reconciled with each other, and the combined Senate bill must be reconciled with the House-passed version. That reconciliation process, which in complex legislation can take months, has not yet begun because neither Senate committee has completed its markup. So it does seem like this timeline is going to take very long, and perhaps this might coincide with the length of our current bear market and crypto winter. So if it passes, companies that operate digital commodity exchanges would have 90 days to register with the CFTC. The CFTC would have 180 days to expedite the registration process, and most of the rules would take effect 360 days after enactment. If it fails, the current status quo would continue, and crypto companies would operate under regulatory uncertainty. So, what is the impact on holders and traders? The upside: more institutional money. Clear rules equals less risk and more big money entering crypto. This of course means more institutional adoption and expansion, which could mean higher market caps and higher prices. We could see increases in crypto pension funds, more interest from banks, and higher ETF inflows. This could potentially give us huge long-term price support. There would also be less regulatory fear, no more random lawsuits nuking projects overnight, and that alone could help to stabilize the market. Easier access, more regulated exchanges, easier onboarding, and more users, again setting the example for global adoption. The downside: less yield opportunities if stablecoin rewards are restricted. Passive income in crypto takes a hit. DeFi could become less attractive. More compliance equals more centralization. Stricter rules could push out smaller projects and benefit big players like Coinbase. Market volatility during the rollout. We're already seeing stocks and crypto react to news about the bill. We can expect large turbulence before any real clarity. So, given the risks and the controversy, here's the reality. The Clarity Act is not universally loved. Banks want stricter rules, crypto companies want more freedom, and politicians are divided. One of the biggest battlegrounds is whether stablecoins should behave like bank deposits. This disagreement has already delayed the bill multiple times, and there's still a real chance it gets watered down or delayed again. So, what's the bottom line? The Crypto Clarity Act could be the most bullish regulatory shift in crypto history, or a slow squeeze on some of crypto's biggest advantages. But one thing is clear: the era of Wild West crypto is coming to an end, and whether that's good or bad depends on how you're positioned. If you found this useful, hit like, subscribe, and let me know. Do you think regulation is good for crypto, or does it kill the point?